The Bank of England's Swati Dhingra says rates should come down now. Welcome to Market Insight. I'm Ramzan Karamali. The MPC member also said inflation was unlikely to rise sharply again. She's consistently voted for rate cuts since February, but only one other member of the rate setting committee has agreed with her. But is that likely to change at the next meeting? Well, to help answer that and more, I'm joined by Tim Graf, Head of Macro Strategy for EMEA at State Street Global Markets. Tim, thanks so much for joining us. Well, later this week we get the latest inflation data. Do you think that might persuade other members of the MPC to agree with Swati Dhingra and cut rates in August?
I think so. That's our central scenario. We track inflation in the UK online using online retail prices, and we scrape that data, and that shows that inflation actually does look a little weaker than what is seasonally normal for this time of year. And the fact of the matter is it's against a backdrop where even in the official data, inflation has been normalizing in the UK. And so I think it does set up for an MPC rate cut in August. That's not fully priced, but it did sound at their last meeting, the minutes from the last meeting, that it only will take a couple of the fence sitters to be swayed into a cut. I suspect that the inflation data, if not this month, certainly by next month, will give them that ability to start with rate cuts.
Well, on Thursday, it's the turn of the European Central Bank and its rate decision. Markets aren't expecting another cut, but today we saw that wage growth is easing across the Eurozone, according to the ECB. So could things change?
I don't think so. I think they're also pretty much nailed on to cut, not at this meeting, but to flag a cut at the next meeting. You'd have inflation pressures again as we track them, but also in the official measures, normalizing quite a lot. You're starting to see normalization in the all-important service sectors as well. That is a lot of good news, and it allows the ECB to be less restrictive than what they are. You've had also a dose, of course, of European political risk in the last few weeks. That, I think, even though they won't necessarily be influenced by that, it will make an easing bias perhaps all the stronger insofar as it helps to potentially eliminate any tail risks around European assets, and it makes it a more supportive environment there. So it's not this meeting, but I think they will lay the groundwork for their meeting thereafter to ease rates yet again.
Well, Tim, you mentioned their political risk, and France's National Audit Office today has issued a pretty stark message on the country's public finances. It says that action is needed to honour its Eurozone commitment on debt control. So how likely can this be managed in this sort of current political uncertainty that we face?
Yeah, I think that is one of the real challenges for the Eurozone. I think it does threaten some of the stability that has been engendered in the last couple of years, but I don't necessarily think it's a massive issue for investors right now. We actually can track the institutional investor flows we have access to via our custody business, looking at their flows in OATs, and actually they've kind of shrugged this off. So as far as it being a political problem, absolutely. As far as it being a market problem, so far, not really. You have quite a relaxed reaction from the investment community to the events over the last few weeks. And as I said before, the ECB has policy tools by which any financial market disruption that might feed into the monetary policy framework, they have the tools to address this. So I think there's a good reason why markets are relatively relaxed about this risk at the moment.
So you're saying the ECB is more focused on sort of the inflation outlook and possibly economic weakness in, say, Germany?
For right now, absolutely. And you see this, I think, in French bond spreads to Germany, where they still have a little bit of a risk premium prior to when the election was announced by Macron. But that has come in an awful lot. And there probably does deserve to be some risk premium built in, and that should last because, as I say, this is a real political problem. It's not to dismiss it. But as far as a market issue that then feeds back to the ECB's monetary policy, it's not to say it's off their radar, but there are far more important factors, such as their path to getting inflation back to target, that I think they'll be far more likely to act upon in either direction, should the risks manifest in those directions. I don't think it's really an issue for them at the moment, though.
Well, let's turn to the US now, and the markets seem to believe a September rate cut is pretty much nailed on. Do you?
I think so. I mean, the Fed has had an easing bias since the end of last year. You, of course, had bumpy Q1 inflation data that complicated that message. But it's interesting, through that period, they never lost that easing bias. They still talked about policy still being restrictive and that rates would stay high as opposed to needing to go higher. Now what you have is an inflation dynamic where you see a lot of a normalization across a wide panel of indicators tracking inflation. And again, our own metrics of real-time inflation for the US that we calculate show this normalization. And I think it does open up the path for a September hike. So yeah, I would look for them to cut rates in September.
Tim Graf from State Street Global Markets. Many thanks for your thoughts. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.